Did you know it was possible to insure your 401k, 403b, or TSP retirement accounts so that you don't lose 40 to 50% of your money during the next market crash? Because that's what I'm going to show you in today's training, how to buy stock market insurance for your investment portfolio. Hey, for those who don't know me, my name is Trader Travis. I am a full-time stock and option trader with over 18 years of experience. Now, I am super excited to be able to share this information with you in the same way my millionaire mentor shared it with me. You see, I grew up American poor in a house with no running water or bathroom. Now, our household toilet was a 5-gallon paint bucket. However, when I was 20 years old, I met a millionaire who took me under his wing, taught me about investing, and then he showed me the same concepts I'm going to teach you today. Now, before we get started, I have a few standard disclaimers here. Everything I'm sharing, it's not investment advice. I'm just teaching it to you for educational and informational purposes only. I'm encouraged to tell you that you should seek independent professional legal, tax, or investment advice as to whether this is suitable for your particular needs and circumstances. Now let's move on to the good stuff. Now, in my humble opinion, this will be one of the most important lessons I've taught in the last decade. Now, the reason why is because as of this recording, October 2018, the market has been heading higher. So people's accounts are fat with gains. But there is one huge problem. Hardly anyone I know has insurance on their account that protects them from losing a ton of money. So tonight I want to show you a backdoor way of insuring a 401k, 403b, or TSP investment account. Now, if you talk to my wife, she's saying I'm being dramatic about, oh, this is the most important video of the decade. You know what? She's right. I am being dramatic because I cannot stand people losing money. So what I want to do is share the way I insured my own mom's TSP retirement account. I'll explain what that is. And then I'll also share what I feel is Warren Buffett's secret to getting rich faster. Now, the backstory to how this came to be is I had a problem and I needed a solution. This is a problem you may also have. Now, my dad recently passed away. So my mom inherited his TSP retirement account. It's a small account. These are retirement accounts for government employees. Now, it's not a bad retirement vehicle. It has good fund choices and low fees, but there is one huge problem. Those kind of retirement accounts cannot be insured against a major loss of money. Sure, you can use old school methods like diversification and bonds, but I have a question for you. Did the old school methods keep people from losing money in the market crash of 2007 to 2009? Let me answer that for you. No. People still lost money even though they followed the experts' advice about having your money diversified, dollar cost average, all that good stuff. Now, my mother does not have that losing money worry because there is a backdoor way I found to insure her account. So when, not if, but when the next market crash happens, my mom won't lose 40 to 50% of her money because she has stock market insurance. And just so you know, I am not the only one who has ever talked about stock market insurance. If you're aware of this concept, you will start seeing it around the web. They may not go into great detail, and you'll need the knowledge to know precisely how to do this. But since you're part of my option family, you should know how to do this. And if not, let me know and I will assist you. But here are a few reputable sites that have explained this concept. Barron's wrote an article, How to Insure Your Stock Portfolio. Market Watch wrote an article, 4 Ways to Protect Your Stock Portfolio Using Options. Investopedia, 6 Common Portfolio Protection Strategies. And then my own broker account, Fidelity, Strategies for Uncertain Times. You scroll down here, protect your profits. Learn how put options can act like an insurance policy to help protect your gains. So what I'm going to do is reveal the 3 steps for you really quick, and then I'm going to unpack that. These are the 3 steps I took to insure my mom's retirement account. You're going to 1, open up a traditional brokerage account or an IRA that allows you to buy stock options. You're going to get approved for level 1 options trading, and then you're going to buy enough protective put options to cover the entire value of your stock market portfolio. That's any exposure you have to the stock market, no matter how well you are diversified. Now, the protective put options are the stock insurance I keep referring to. So before I go into detail, I'm going to unpack this for you. let me tell you why you absolutely need stock market insurance. And I'm going to start before I talk about the tale of two investors, I want you to think about something. Have you ever known someone who has a car or house and they didn't have an insured? Or in our case, a family member, a breadwinner passes away and they don't have life insurance. What happens to those individuals? They suffer. So that alone is why you need insurance, because if you do not have it, you will suffer, whether it's your car, your home, or your stock market portfolio. This is your money. So if you do not insure your stock market portfolio, you will suffer in the next market crash, right? Now I'm being dramatic, but what if you're like my wife, when I yap, she doesn't get it. She needs examples, illustrations. So let me take you to the slides and give you the tale of two investors. They are John and Henry. You see, John and Henry both start with $100,000, but then they head into a market crash, bear market, where the market drops 55%. John lost 55% of his money. He didn't have insurance, so he's left with $45,000 in his account. Well, Henry, he only lost 4%. That was the cost of his insurance premium. So he still has $96,000 in his account. Now, after the crash, John is aggressive. He didn't like losing all that money, so he uses an aggressive strategy where he earns 15% a year on his money. Henry, he's conservative. He earns a measly 7%. Now, how long before John catches up with Henry? John is earning double the return that Henry is. Yes, he has a smaller balance, but he's earning double the return. How long in years will it take for John's account to be the same as Henry's? It takes 11 years. You're like, no way, Travis, 11 years? I don't believe you. I knew someone would say that, which is why I wrote it all out on the next slide here. Okay, we have Henry's account here on the left, and then we have John's account on the right. And this is, if you earn 7% a year on $96,000, this is where it would look like as you progress. Now I have 2 points I want to highlight first. Henry only takes a year to get back to break even, to get back to his starting balance. John, on the other hand, it took him 6 years. He was earning double the return, and it still took 6 years for him to get back to his starting balance. Now, here's why. This is what I call the secret investing loss formula. The reason it's a secret is because the financial experts are always wooing you with the beauty of compound interest. No one tells you about the unfairness of losing money. You see, when you only lose 10% of your account, you only need 11% to get back to break even. Losing money is a very unfair formula. When you lose money, you need to earn more just to get back to break even. So if you lose over 50% of your account, which happens in a market crash, your account will need to double just to get back to break even. This is one of the reasons why it's vital that you stop the bleeding in your account. You protect your account from losing a lot of money. Let's move forward here. 11 years later, Henry's account is $202,000 and John is at $209,000. So it took John 11 years to catch up with Henry. Now, this example proves what most people falsely assume. Most people falsely assume that building wealth, becoming rich is about earning more. Well, there's a guy, a billionaire investor named Warren Buffett. This is courtesy of WikiQuote. Now, he has 2 rules of investing. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. I hope this example illustrates that. Losing money set John back 11 years. Now, this is a generous example because it pretty much assumes that in 11 years, there's no market crashes. Now, of course, it's not going to work out exactly like this. You never discover this because you're adding money to your account. You see your account growing. But if you never added any money to your account, this is the only way you will discover this. Or the other way to discover it is putting math behind Warren Buffett's 2 quotes. Don't lose a crap ton of money. When you do that, you will see why he has those quotes. Losing money is a very unfair formula. Now, I want you to think about something. We insure our cars and our houses without hesitation because that's what we've been taught to do. But no one's taught us to protect our most valuable, our most precious asset, the money we worked hard to obtain. Now, let's come back here real quick because I didn't talk about what I feel is Warren Buffett's secret to getting rich faster than other people. Henry is far richer than John after the crash just because he lost less money. So let me move on here. I don't want to lose people with the math. People who hate math, forgive me, bear with me. Yes, hate the pointless, stupid math you learned in school. Fall in love with the simple math that makes you rich. Learning how to not lose money is math that makes you rich. So again, here are the 3 simple steps. Now, the protective put options are this stock insurance I keep referring to. So let me briefly show you 2 examples of how this stock insurance works. So the first example is I'm going to show you buying insurance inside of the same investment account. Then the second example is what I did with my mom's TSP retirement account. I had to buy insurance in a different investment account because the traditional retirement accounts do not allow you to trade options inside of them, or as far as I'm aware. All right, so let's start with example 1. I'm going to log in here to my TD Ameritrade account, and I have a stock right now that I bought about a year or so ago, and right now it's down 35%. Now this is actually good because the other day it was down 40%. But regardless, you can see I own some stock here. I have a loss, 35%. Isn't that what people lose, around a market crash? However, I am not worried whatsoever because I bought insurance for this stock. So now what I'm going to do is go to my TD Ameritrade brokerage account and let me pull up what they call an option chain. That's beyond the scope of this particular training video, but keep a big picture in mind. I'm going to show you something here. So this stock is currently trading at $35. If I bought it right now, it will be $35. If I bought this 36 put option right here, this protective put option, if I buy this contract, it gives me the right to sell this stock at $36 up until the expiration date. Every insurance has a expiration date, right? How long your insurance policy lasts, 6 months, 1 year. This particular insurance policy is only good for 92 days. So from now up until 92 days from now, I would be able to sell this stock for $36. So no matter how far this stock fell, it could fall to $20. This contract right here guarantees I can sell it for $36. Well, I have one of those contracts. So again, let's come back here so I can show you the numbers here. I bought this stock for $8,115. This down here at the bottom is my insurance contract. I can file an insurance claim here. Now I'm going to move this real quick up in the recording window so you can see this. If I right click this insurance contract, I can file an insurance claim. This exercise right here. If I click exercise here, this is me telling the options exchange, hey, I want to file an insurance claim. I hit confirm and send. You will see that the broker will put $9,000 back into my account minus my commission. So $8,985 will go right back into my account, thus wiping out this 35% loss I have. That's how all insurance works. Your house burns down, you get a check to cover the cost of your house. You total your car, they give you a check to cover the total value of your car. It's the exact same thing with stock market insurance. So the summary here is I bought a stock, it went down in value, right? Ever happened to you? You buy a stock and it goes down? I didn't like that. So all I'm going to do is come in here and file an insurance claim and get all my money put back into my account. Now, the challenge here is you cannot do this with a traditional retirement account because they do not allow you to trade options. Well, most of them don't. So we can still do this. We can still use this same tool, this protective put option. However, there's one slight twist. The slight twist here is we have to open up a different account, a separate account. Then we're going to buy protective put options on a broad-based index like the S&P 500. Now, here are the 3 symbols I use, SPY, DIA, and QQQ. Now, what do I mean by a broad-based index and why do I use that? So let me explain it to you. A broad-based index is the stock market, S&P 500, Dow Jones Industrial Average, or the NASDAQ. Well, here's a picture of the market crash 2007 and 2009. No matter how diversified your portfolio is, when a market goes in a crash, right, we want to benefit from the stock market falling in price because those put options I just talked about, they go up in value when the stock market goes down in value. So we want some kind of stock market exposure. We want to buy a put option on something like SPY, which is the ETF of this S&P 500. The ETF is an exchange traded fund. This ETF allows us to get exposure to the broad-based index, the S&P 500. So what we would do is, for example, I bought put options, protective put options on SPY, so that when the S&P 500 falls in price, my put options will gain value and I will make money, thus offsetting what my mom is losing in her TSP retirement account. So my broker has what they call an Analyze tab, where I can go back in the past to this market crash or any kind of correction and show you how these put options work. Okay, so what I'm going to do is come to the Analyze tab on my broker platform, and I'm pulling up January 26, 2018. Now, this example is not going to work out picture perfect like this, just to show you a real life example of how put options work and how this will factor into ensuring your traditional retirement accounts. So SPY, I'm going to show you two examples here. I'm going to get an insurance contract that's roughly about 6 months out, just a typical at the money insurance contract. You can compare the difference between how each one behaves. Then I'm going to come out here. First, SPY is at $286.58, so we're going to keep that price in mind. And then I'm going to come to what I consider people do, or what I recommend people do. Come as far out as you can for your insurance contract. And the reason why, it's cheaper on a per month basis. And so let me show you that real quick here. For those who hate math, just bear with me for a little bit. So what I'm going to do is take this 9215. I want to divide it by the strike price of $287. And that tells me that premium of $9 or $900 represents about 3% of this stock's strike price here. And remember, it's a 6-month policy. So we take that 3% and divide it by 6. And so this insurance is going to cost us about 5.5% a month. All right. If we want to average that out, we had to do this, get 2 contracts every single year, it's going to cost us 6%, a premium of 6%. So 6% of our account will go towards insuring our portfolio. All right, now think about that. Now let's come over here to 1057 days out. That's a heck of a long time. So a little shy of a 3-year insurance contract. Now we're going to take the same price, the 3007, divided by the strike of 290. And it's going to hurt. You're like, man, that's 10% of my account is going towards insurance. But remember, it is 34 months. So we take that 10% is going to cost you by 34 months. And that gets your per month cost of 0.3%. Average that out each year. So each year, this insurance is only going to cost you 3.6% versus 6%. If I lost you the math, just keep a big picture understanding. Go as far out as you can. Here's a directive. Go out as far as you can to buy your insurance, because overall it's going to be cheaper and is going to save you on commissions and having to constantly renew your policy and all this other stuff. That's what I do. You can do what you want. I had to learn this the hard way. Buying these short month insurance policies over the years, I'm like, crap, it just cost me a bunch of money. So I solved that issue now. I go as far as I can. And I just, people, well, do you do at the money, out of the money? You can figure that out on your own. I just pick something simple, at the money, and I figure out how much insurance or how many contracts I need to buy. This stock would require me to buy the stock at 290 times 100 shares. So each contract here I buy is insuring roughly $29,000. So my mom, let's say she only had, $20,000 in her TSP account. I'd only need one of these contracts, and I've overinsured her account. I could come out of the money a little bit, but again, for me, simplicity purposes, I just pick at the money. Now, I'm going to do 2 contracts here. I will explain why I'm going to do 2 contracts. Again, she only needs 1 contract with that size account, TSP account, 20,000. But I'm going to explain why I'm going to do 2 contracts after I fast forward here to our little 10% correction. Our 10% correction now, I'm going to find that same July put option we bought, 287. It's now in the money because the stock went down. And if you remember how put options work, put options lock in a sales price. If you buy a put option, it gives you the right to sell a stock at a set price up until its expiration date. Remember, the stock was at 286. About a month later, after the 10% correction, now it's at 261. So it's a little shy of falling 10% in value. And so we went ahead and I found, let's actually find the other insurance contract I bought, the December 290 here. And so you can see the closing prices and the profit and loss difference between each one. All right, now I showed you two different ones for comparisons here. Again, I don't like the shorter term insurance contracts because you constantly have to renew them and they're more expensive than long haul. But look at the profit here. So remember, my mom only had a $20,000 TSP. So if the market went through a 10% correction, she would lose roughly $2,000. However, look at the profit of these puts right here. $2,600 for the longer term one, $3,600 for the shorter term one. Don't get caught on which one made the most money. Well, you can if you want. You do what you want. I go out as far as I can. So she lost $2,000 in the TSP account, but these puts offset that, so they make money. So she will still lose money in her TSP account. There's no way around that. And going back to put options, how they work, they lock in a sales price. So think about put options. They allow you to lock in a sales price of $287 or $290. The stock is at $261. We have a contract that gives us the right to sell something at a higher price than it's trading at. That makes the contract valuable. That's why put options go up in value as the stock market goes down in value. So looking at the profits here, the difference between 2,600 and 3,600, don't get caught up on the profit. A lot of people get caught up on the profit and then pick the shorter term options. You can do that if you so choose. My experience has taught me to go out as far as I can. Yes, it's more expensive. Yes, it hurts giving up a bunch of money up front. But over time, it's way cheaper, and my dividends. Matter of fact, I'll show you different ways you can pay for it. But this will help offset what my mom will lose in her TSP account. So she will lose in her TSP account. She will lose money in her TSP account. There's no way around that. But she will have this other account here with put options, a protective put options in it. They will be making money, offsetting what she's losing on her other account. So the summary is she's going to lose money in one account, make money in another account. Now, imagine if this was a 40% decline. This was just a small 10% decline. And throughout these dates, it was actually about 8%. So imagine how much more these put options will be worth when about a 40 to 50% decline. Now, the reason I bought two protective put options right here is this is one of the ways, best case scenario, you can obtain your insurance at no cost to you. All right. So if this kept going down in price and these put options became more valuable, it'd be more profit. So she'd sell these for a profit. The profit would offset the lost money in her TSP account, and best case scenario, it may even factor in the cost of her puts. So pretty much if she get a 200 or 300% return on these put options, she's more than recouped whatever she's lost from her TSP, and she might actually walk away making money during a market crash. The other way puts can be paid for is through the dividends of your stocks. So the longer term puts, the ones I always buy, remember it costs me maybe on average about 3% a year. Those puts, the premium for that, 3% of my account a year to pay for those puts. So dividends alone, 2% dividends, they pretty much offset what it cost me to buy this insurance. Yes, it eats into my profits, but building wealth is not about how much you make, it's about how little you lose. Warren Buffett, the billionaire investor, gets that. That's why he has 2 rules of investing, which essentially says don't lose a crap ton of money. You notice he doesn't say, earn high returns. He says don't lose a crap ton of money. A third way you can pay for dividends. So first way is just buy more puts than you need. Best case scenario, they'll double, triple in value. Second way is your dividends. Third is your gains. If you're continuously renewing your policy every couple of years, you're locking in these gains as the stock market goes up. So the stock market went up 21% in 2017. You gave up a few of the percentage points of those gains for your put option, but that's worth it. It's worth it to protect those gains versus being the sorry soul who lost 40 to 50% of his money when the market crashes. I'd rather be the person who gives up 4% of my account in order to not give up 50%. So I exchange a 4% loss to avoid a 50% loss. So this is not a perfect solution like my VXX stock where I can get all the money put back into my account, but it is a better solution than losing 40 to 50% of your money. And I know I've done this for a long time. Some people will look at this, they'll throw out a gazillion objections, but the reality is if you lose $1,000 or you lose $2,000 in one account, you gain $2,000 in another account, what difference does it make? So that's the backdoor way I have found to insure 401k accounts, 403bs, or TSP accounts, or any kind of traditional retirement account that doesn't allow you to trade options. Again, it's not a perfect solution, but it's better than going into a bear market with no insurance whatsoever. And just to reinforce this example, I decided, let me come back to the market crash of 2007, 2009, and I just pulled up the insurance contract I would usually buy here so you can see the profit here of $14,000. Now, if my mom, again, has a 20 grand TSP account, this insurance contract, 155, I bought 2 contracts, so that insured up to 200 shares. It represented 200 shares of stocks. These option prices always have to be quoted by 100. Each contract represents 100 shares of stock. So the summary here is I bought enough to insure a $31,000 portfolio. So her portfolio was overinsured. Now we look at the cost here. It has a premium. We're going to multiply that premium by 200. It costs $2,685, $2,685 to buy that insurance. However, she made $14,265 profit. You back out the cost of the insurance and she still made a profit of $11,000. Now, if she had a $20,000 investment account, she lost 55% of it, over half of it in a market crash. She essentially lost $11,000. But did she really lose $11,000? No, she did not, because she had insurance. So the downfall with this approach is, yes, she cannot file a claim like I will on my VXX and put the money back into her TSP account. However, she will have this other account that is making money, offsetting what she is losing in her TSP account. Now, this is a huge warning for you. This is something that must be done before the crash. The sooner, the better. I'd do it within a week if I was you. Because you cannot insure a house after it's already burned. You cannot insure a car after a crash. You cannot insure your stock market portfolio after you've already lost money. Once it's lost, you can't get it back. You'd put yourself behind financially forever. I've showed you examples of that with John and Henry. And just in case you didn't get what I was hinting at earlier, do not look at this insurance as a cost. You can if you want, but the way I look at it is, it's a peace of mind premium. And if you are like how I used to be, too cheap to pay the premium, then you will pay a cost. It's the cost of inaction. It's the cost of suffering when you lose over half your money in the next market crash. All right, so here are the 3 steps I've been talking about so much. And what I want to do is show you an example of these 3 steps in action. I'm going to start with steps 1 and 2, open up a traditional brokerage account or an IRA that allows you to buy stock options and get approved for level 1 option trading. What that means is level 1 option trading is the most basic level of option trading, and it just will allow you to buy options. In this case, we only want to be focused on buying put options. Traditional brokerage account or an IRA, you can trade options in both. A lot of people don't know that. For my mom's case, she already had a Roth IRA at Charles Schwab, so we just use that. But you could open a taxable account. The 3 brokers I have taxable accounts in are TD Ameritrade. These are not recommendations. I'm just showing you what brokers I use. So TD Ameritrade is one of the brokers I use. I also use Fidelity, and that's where I have an account. And then I also myself have a Charles Schwab account, just like my mom. So that's what it worked out that she used Charles Schwab because I was already familiar with that platform. And so if you've never opened up a brokerage account or you're unfamiliar with it, you literally can call them or chat with them and you tell them, I just want to open up an account so that I'm able to buy put options to kind of as a form of insurance. They will probably like you. And that's what I mean by level 1 approval. You're just telling them, hey, you want to buy put options. They will understand what you're talking about. And they may actually like you because now you're trying to open an account to protect yourself versus some people want to trade options to get rich quick. The ones who want to speculate or try to get rich quick, the brokers, they don't like those type of clients. They're high risk clients. And so they often will deny their accounts from getting approved. But if you let them know, hey, I'm just using this for protection. I just want to open an account so I can buy put options for protection. Your account will most likely get approved. Now, the third step is to buy enough protected put options on a broad-based index like the S&P 500. And again, I want to show you an example of that. Broad-based means, hey, if the S&P 500 is what they consider the stock market. And what this means is if the stock market crashes in price, we just want to be in a position to benefit from it. That's why we're doing something like the S&P 500, the Dow, the NASDAQ. Don't fool with anything else. These are the only three I stick with. These are the symbols I use. They're the way I can buy put options on these three, and I will benefit if the stock market crashes. So for this video, I'm going to use SPY, which is the ETF of the S&P 500. It mimics the movement of the S&P 500. First, let me log in, continue my session. My mom's TSP account here, it was just in L income funds for those who are familiar with the government retirement accounts. And so this is for where she's at in retirement. So it's an income fund. So I just want to show you that to show proof that, hey, I'm familiar with these accounts. And as far as I'm aware, you can't trade options in these accounts because of the regulations. So that she has no protection. So if the market crashes, she stands to lose her money, and she's in retirement. She cannot suffer a loss. And so what I wanted to do is protect her, protect that money that's in this account. So we can't do it within this account, but we can come here to another account. So this is what the Charles Schwab platform looks like. So I believe I've already talked about it in another video, but look, if the market does crash, she's going to lose money inside of her TSP account. I have not found any way around that except for the traditional methods like diversification and things like that. The reason I don't really like those is because in the market crash of 2007, 2009, that didn't save people. They still lost a lot of money. Put options are the only way I found to guarantee I will make money when the market crashes. So here's what this third step looks like. You're going to buy enough protected put options on a broad-based index to cover the entire value of the stock market portfolio. The entire value of her stock market portfolio is $20,000. That's how much exposure she has. That's how much money is subject to losing money. So I'm going to come here, and you can call your broker. They will walk you through this. Every broker is different. This is not to show you how to do it only on this platform, just showing you how simple it is. It takes literally a minute or less. So I'm going to do this trade tab. I'm going to do options, and then I'm going to do SPY. That's the ticker symbol I'm looking at. You can see it here. Spider S&P 500 is the ETF of the S&P 500. And the insurance I recommend people buy is to come furthest out in time, as far as you can go. In this case, this is a little over 2 years. It's a 2-year insurance policy. The reason why is the further out you go in time, the less expensive it is. A lot of people look at the cost and they try to be cheap and they go further up and buy like a 6-month policy. Do not do that. It's cheaper on the front end, but more expensive in the long run. This January 2021 is more expensive on the front end, but cheaper in the long run. I don't want to lose you in math and proving this, so just trust me on this. It's cheaper in the long run. Go out as far as you can. So this is about a 2-year insurance policy. Remember, her balance is about $20,000. I'm going to pick this 250 put right here. Reason why is that I take this strike and I multiply it by 100. Option prices and quotes and strikes and everything else usually always have to be multiplied by 100 because every option contract represents 100 contracts. Every option contract represents 100 shares of stock. So by me buying this put, I'm insuring roughly about a $25,000 account. So I am over-insuring on her account. I'm buying a little bit more, and that's fine for me. I'm going to click buy to open. I'm buying to open a new position. Again, it's going to look different on every broker platform. So just literally call your broker, say, hey, can you walk me through buying a set of put options? My order type. Now, I am going to do a limit order for you. I shudder to recommend this. I recommend you do market order. It'll get filled right away. You're done. You don't have to worry about it. Quick and easy. That's what I recommend for you. It's because I have more experience with options and because I'm always cost conscious, I'm going to do limit. And what this means is I want to pick the price I buy it at. The market order tells the exchange that you want to pay whatever price, and you will just pay this ask price. It's $21.20. That's essentially what you're paying, full price. That's fine. There's nothing wrong with that. What I want to do is I want to try to see if I can save a little bit of money here, and I'm going to put in my order at about $20. So that saves me about $1. I don't recommend you get all cute with this. Just pick a market order and be done with it. You're going to get close. But again, because I'm just cost conscious and I've been trading options so long, it's just my habit. Always do limit order versus market. But the way I teach my sons, my 7-year-old, my wife, I teach them to do market orders and be done with it. Because sometimes the limit orders don't get filled. And unless you have experience to go back in and check on it, you might think you bought insurance but didn't. So again, just pick market order and be done with it. Regardless, the same process is the same. Hit review order. And so again, I'm buying more insurance than I need. It is going to be about $2,000. And once I place this order here, I'm going to come back in and just show you this little bit of math right quick. All right, so let's look here, and we're going to focus on how much it cost me, $2,000. So remember, my mom's account fictitiously is $20,000. So you're looking at that insurance contract just cost me 10% of my account value, right? That's a lot. But remember, it's a little over a 2-year insurance policy. So it's really only 5% a year. And if the stock goes up more than 5%, it insured my account. So I can deal with this. And there are other ways I get to pay for my insurance. So I want you to think about this. And I'm going to go back to the PowerPoint slides and kind of walk you through mentally what I'm looking at here when I'm looking at this 5% per year cost to insure her account. Now, what I want to walk you through is what actually happened so you can kind of see, what worst case scenario is, because you need to think about this. This insurance it's not like unicorns and Santa Claus. It has some downfalls, and the downfall is it's just like your home or car insurance. If you never file a policy, that money you spent, that $2,000 I spent, that's lost, right? That is done. So I'm going to show you. So that's how I think about it. Here's the potential I could lose this money. So as a 2-year insurance policy, it costs me about 5% a year, 5% of however much money I have in that account, which is about $20,000. It cost me $2,000 to insure that account. But what that does is prevent me from losing $11,000 later. So it's either, I take a $2,000 hit now, or I take $11,000 hit later. So that's how I think about it. Worst case scenario, I'm planning for the worst, hoping for the best. Okay. The best is, in this case, the market crashes. I only lose $2,000 versus $11,000. And what I mean by $11,000 is if the market crashed by 55%, my little $20,000 account will dwindle down in value. I'd have $11,000 lost without insurance. Sorry, that's unacceptable, especially to someone already retired. You cannot suffer any losses. We need to follow Warren Buffett's 2 rules. So I'd rather take a $2,000 hit right now. Okay, that was best case scenario. You're like, whoa, how is that best case scenario in the market crashing? Because I lost less money. Worst case scenario actually is the market keeps going up. And that $2,000 I paid, that's money I lost. And that's everyone's fear. That's what they're worried about. That's why people are hesitant to buy insurance. First, it's expensive. 2, they're like, man, I can't keep throwing away $2,000 every year. So I've mapped it out. This is what it will look like. This is what you're worried about, right? I'm using the market we're in right now. The market has been going up 10 years straight. That is unusual. It usually doesn't happen like that. But literally, this is exact worst case scenario. So I showed 2 examples of 2 investors starting with the same balance. One earns 7% a year. One earns 3% a year. In this example, I used insurance costs about 4% a year, but it's still come around the same. So 4% a year, you're paying for insurance, which means you eat into your profits. The market goes up, right? You only earn 3% a year. That's not a lot of money. For the market goes up for 10 years straight at year 10. Let's look at year 10. No, as a matter of fact, let's look at year 11. Go to year 11 here. So after 11 years, your friends who didn't buy insurance, their balance is at $202,000. Yours is only $132,000. Your friends, they didn't buy insurance. Why? They don't like losing money. They don't like losing $2,000 a year. But that's exactly why they needed stock insurance, because it prevents them from losing money. But they look like heroes right now. They look like pretty smart. You look like the biggest idiot of the decade. Their accounts are almost double yours. They've laughed at you. They made fun of you. They've called you Chicken Little. They call you an idiot. Look, I can understand if you've lost faith over those 10 years, you've given up, because it's really hard to stand up to that kind of peer pressure. It's even more harder watching everyone else get richer year after year for 11 years straight. We're not talking about a little bit richer. We're talking about a lot richer. But then, year 12, the market finally crashes. Your friends with no insurance, they lose 55% of their account. Their balance is now cut in half. Their account is at 90,000. Remember, you only lost your measly 4%, which is what's the cost of your insurance. Your account was fully protected. Your account now stands at $127,000. Remember, Warren Buffett gave us the secret to getting rich faster. Don't lose a lot of money. Who's the idiot now? You or your friends? You're richer than your friends. Are you vindicated? No, you're not. I can tell you from personal experience, they will just call you lucky. They won't acknowledge that you were just smart and well prepared. You followed the rules of a billionaire. No one likes losing money. People certainly don't like, being wrong. So it's going to be hard for them to be happy for you. You're the one richer than them now, and they're the ones looking like an idiot. So I just wanted to map this out for you because this is the mindset shift that needed to happen for me. I had a fear, like I don't like any kind of insurance, but I have to tell myself it's insurance against a disaster that will take me out financially. Then you put math behind your fears. Let me map this out. Worst case scenario, what is going to happen? Map it out 10, 20 years, whatever you want to do. This shows me that, okay, yeah, it's going to hurt for 11 years watching everyone else get rich. But if the market crashes in that 12th year, even despite me paying for insurance all this long time, I still come out ahead following Warren Buffett's 2 rules. And that's not even using advanced techniques, how I generally obtain my insurance at little to no cost to myself. This is if you never have any kind of advanced strategy or way to recoup the cost of insurance, you just out of pocket it. This shows you what it looks like, worst case scenario. So the last point I want to leave you with is when things are going great and people are making money, let's back up here. It's natural. No one's focused on buying insurance. The market's been going up for 10 years. You know what? Nobody's thinking about the market crashing. They're just too focused on all those fat gains in their account. But that's when they're blindsided when things go bad, when the market actually does crash. That's why I teach every one of my members, every one of my students, you focus on risk first, profit second. Prepare for the worst, hope for the best. That way, when worst case scenario does in fact happen, because that's the one thing I can tell you about life is it's unpredictable. Worst case will eventually happen. When it happens, you're prepared for it. So my final takeaway, my suggestion for you is kind of, work through any hesitation you have about the stock market insurance concept. If you have any hesitation, let me know so I can walk you through how I overcame it mentally and how now I have peace of mind. Also know that, I just unleashed a bunch of information on you. And if this is your first time, hearing about these concepts, it can be overwhelming. So this is something you're going to have to watch over and over again, or again, ask questions so I can help clarify these concepts. But mainly, I want you to keep a big picture overview that it is possible to insure your stock market portfolio. And for me, that protective put option insurance, it's not a cost. It's an investment against disaster that will ruin me financially. What puts people out of business, making money or losing money? But why do so many people focus on making money? They totally ignore the business of protecting their assets. And what I have found after studying wealth for over 18 years is that becoming rich is not so much about how much you make. It's about how little you lose along the way. And I hope I've done a great job of proving that in this training, because that's how you become a billionaire. Consistently lose less money than everyone else over time. Remember Warren Buffett's 2 rules of investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And I'll leave you with the words of one of my friends, because one of my friends, he did not have his stock market portfolio insured during the market crash of 2007 and 2009. And he wound up being a victim of the stock market. This is one of my closest friends, but I'm going to let him tell you in his own words.
If you stay engaged and you learn something and you increase your financial education, this is what you can do. I didn't start doing this last week or last month. I've been a part of Travis's Success Academy for many, many years now. And what drove me to its Success Academy was a market crash of 2007 and 2008, where I had professional money managers who were supposed to make my life a little easier. And it didn't. I watched my account drop by 46% in a year and a half.
Now, the pain Peter went through is exactly why I'm recording this training, because I do not want you to suffer in the next market crash. Peter can't get those lost years back, but luckily we got him on track. And not only does he have now peace of mind about heading into retirement, he actually wound up retiring early. Now, I can't guarantee that will be the same result for you, but why not you? Why you deserve to retire early as well as retiring with more money than you need for retirement. Because my heart's desire is for you in the next market crash to lose no more than 1 to 5% of your money. Now, if you found any value in what I've shared with you today, I need a small favor from you. I need you to help me be a disciple of this stock market insurance information. I can't do it alone. I need you to tell your friends, family, anybody near retirement, in retirement, approaching retirement, or anybody who just doesn't want to lose money. Let them know about this concept. Help me protect people so that they don't needlessly suffer in the next market crash. So that's all I have for you, and I hope this video has added some value to your life, and I hope to one day hear your success story about how you protected your accounts during a market decline. You take care, and Godspeed.